Colin, I can't hear you.
Hi, sorry about that, everybody. Morning. Welcome to the Lending Technology Think Tank. It wouldn't be a technology event without some kind of technical issue. Of course, I made the faux pas of putting my microphone on mute. So huge apologies, but welcome to the event. This is the fifth Lending Technology Think Tank edition of the series that we run, which is designed to bring together lending and creditor professionals to discuss strategies and assess technological innovations that can play a role in producing best customer outcomes. So these events, really, we've got 4 sessions planned across the day, which I'll share with you now. This is the first one. Shortly, we're going to be looking at, obviously, credit risk and the cost of living challenge, which should be really interesting. We have a slight break. So for those of you who haven't joined the event before, we have a slight break and you log back in if you're interested in learning more about the second session, which will look at measuring affordability. The third session will look at regulatory impact on lending. That will begin at 11:55, and then we'll have a brief lunch break for 15-20 minutes, and we'll round up the day talking about digital lending. Now, each session, we've got 3 to 4 panelists, and they will each discuss some of the challenges and solutions, hopefully, that they've found across those different category settings. But before we start our first session, I just wanted to really briefly talk you through the platform you've got in front of you. Obviously, you can see this video, but on the left-hand side, you've got options to view speaker profiles. You can download the odd bit of information, and you can also ask questions, and we really push that. We'd love to hear from you. Just type in the question and we'll put it in our chat, and then we'll share that with our panelists via our chair. Anything we don't manage to cover off, we write a review after this event. So in about a week's time on the Credit Connect news site, we will write a brief review with some answers to some of those questions. So keep them coming in today. We really appreciate any feedback and information that you can give in addition to what the panelists are sharing. Socially as well, we don't go in massively on social media, but in terms of Twitter and LinkedIn, we're quite strong on that. So if you want to comment on the event or provide some kind of feedback, that'd be awesome. Use the hashtag LendTechTT. But before we carry on, I'd just really like to say a big thank you to all of our speakers and particularly our sponsor, Experian, who are helping support this event. So you'll hear more from them in future sessions, but these events don't just happen. We just need a bit of support every now and again. So thank you to them. But to move forward, let me begin by introducing our chair, Chris Warburton from RO Strategy. He will introduce our panelists and create the flow for this session. So Chris, over to you.
Thanks, Colin. So just to introduce myself. So my name's Chris Warburton. So I've been going to be the chair for the event. My background, I've been sort of like the last 20 years really in sort of like risk operations, sort of covering everything from origination, lending, all the way through to fraud, and then the collections piece as well. I know we've got a really great session today. So the Lending Technology Think Tank, as Colin said, we're going to cover credit risk and the cost of living challenge. We're going to talk about affordability, regulations and the change on lending, and then digital lending technology right at the end. So I think the session's being recorded. So Colin will be posting polls, I think, throughout this as well. So and as Colin just said, if you've got any questions, just pop them in the chat, and we'll try and answer them on the call live if we can. Otherwise, there'll be a wrap up, and we'll get the answers back to you via email as well. So welcome to session 1. And this is really around sort of credit risk and the cost of living challenge. I mean, I would say that I suppose that the start of this year has been sort of quite a year, and we seem to say that every year, but it seems to be quite a year. But we've had interest rate changes, we've got inflation that seems to be rippling through. There've been just huge amounts of sort of like economic change going on, and the cost of living, which was rumbling for a while, is now really feeling like that's starting to sort of really come through, and it's been around for a while now. So we're going to talk a little bit about that today in terms of what impact is that having on lending? How do we need to think about that in terms of like the impact on credit risk and credit and adjudication and affordability, etc. So with me today, we've got a great panel. We got Louise, who's a compliance manager for interim registrations at the Lending Standards Board, and the LSB basically provide independent oversight within financial services. We've got Paul Martins, and Paul is a senior mortgage consultant at Mortgage Evolution, so the mortgage advisor and broker. So we've got expertise there around the mortgage market. We've got Neil Kadagathur, who's the CEO of Creditspring, and they do fixed fee lending. And we've got Chanuka Perera, who's the head of UK credit risk at Zilch, and they're in the alternative lending BNPL space. So thank you to all of the panelists. I think we've got a great panel. We can obviously cover huge range of the industry here as well, from all the different sectors. So welcome. Thank you very much for joining us. So to start off, I suppose just wanted to take a bit of a step back and talk about what the market's looking like. What's the lending market looking like? And maybe if I just start off, maybe Paul, if you want to start just in terms of from a mortgage point of view, what are you seeing in terms of the mortgage market? In terms, I mean, is it a buoyant or is it a hesitant market? What's your kind of sense of where we sit at the start of this year?
Yeah, I think it's fair to say, Chris, it's hesitant. Certainly before the issues with the mini budget that obviously turned out that never potentially was. Things were going along very well. There was obviously the bubbling in the background of this cost of living crisis was slowly creeping up on us, but I think it's fair to say that the mini budget that under Truss and Kwarteng that basically kicked off a series of events that pretty much has led to a very, very, very hesitant market. And unfortunately, it is still like that way. We are seeing a few little green shoots coming through, which is encouraging. And as we hopefully get into the warmer months, into the spring, etc., that is a typical time for an upturn in the market anyway. So we're hoping that those fair winds come through and sort of take the market on as we're hoping it will do.
Yeah. Okay. And Neil, from more of an unsecured kind of aspect, I mean, what are you kind of seeing?
Yeah, it's interesting because we're seeing, very different trends. It's all related to the same problem, the cost of living crisis, higher rates, but we're seeing a huge increase in demand. And just to give you an example there, we in March, we processed over 3.2 million applications for a Creditspring membership. And that compares to, let's say pre-cost of living crisis, so 2021, an average of, just over 1 million memberships. So the demand for credit is increasing. And, this is unsecured credit. 90% of our members are renters. And it's just a function of people having less money at the end of the month and needing to borrow to get by.
Yeah. And Chanuka, are you seeing a similar picture in your kind of space?
Yeah, we are. So as Neil was saying, what we're seeing is that most consumers are the most credit hungry they've ever been. And as an industry, we need to make sure that we're not abandoning these customers at this point. But we also need to make sure that they're not over indebted at their most critical moment right now.
And I suppose, Louise, coming to you to I suppose comment in terms of like there's a consumer aspect to that as well, which is, so it sounds like from what we're hearing is almost like the mortgage space seems like it's less buoyant for the larger sort of secured loans, but that's sort of like that, maybe that near prime kind of sector, or where people are a little bit more cost stretched, a little bit of a turn towards consumer credit. Do you think is that kind of what you're seeing from a consumer point of view? Does that jive?
It correlates, and it's actually really, really interesting. So what we're seeing is that more customers are struggling than ever before, which unfortunately is what you would expect. Customers who previously were in financial difficulty are being more squeezed. And those customers that were previously financially stable are now finding themselves in hardship for the first time. And I think a big factor of that is it's just very, very hard to predict your financial stability or your financial expenditure when your bills are rising month on month. It's really hard to do. We're seeing slight discrepancy, I guess, in what our lenders and banks are seeing. So they're not seeing as many customers come to them to say they're struggling just yet. And we don't know if that's because customers are hesitant about coming forward and speaking about that. But on the inverse, we're speaking to debt charities. They're telling us they're having unprecedented volumes of customers contact them. And we've also seen, we've done some work with around illegal money lending, and we're seeing a huge rise in that area as well, which indicates that customers are struggling. They are trying to find finance in different ways. I guess the challenge is how you reach those customers and have the right conversations, especially for that set who previously weren't in financial hardship and aren't quite sure where to turn.
Yeah. So I mean, it sounds like there's still a need, a need or a desire from a credit point of view. You know, I suppose there's the concern is just sort of like, you know, how do we then adjudicate to make sure doesn't create problem debt as well? I mean, particularly Chanuka and Neil. I mean, what's your view in terms of like how some of this stress, I suppose, that's coming through the system is going to affect some of the I suppose the credit risk adjudication, you know, and what that does to sort of like risk appetite.
Yeah, I'll just answer that first, but just to actually put some more stats up behind what Louise was just saying as well, to go into it, we recently conducted a survey, and 20% of respondents said they previously only borrowed for big ticket items, and now they're borrowing just to get by. A quarter of people who've used high cost lenders are using them just to pay off other debts. And it's just, it's getting bad, right? And and then we'll see that as an increase in credit demand. But what that means for lenders is we have an obligation still, FCA obligation, and just a general obligation to make sure someone can afford the credit as well. They can afford it and they're credit worthy. So it just means, at least in Creditspring's experiences, we've raised our decisioning thresholds. We've increased the criteria that it needs to get accepted. And it's, just simply, it's people have less money, which makes them, as a whole riskier, makes it harder to repay debts. So lenders need to take that into consideration, not just with regards to, will they make money on it? Because that could be solved by raising prices, but actually really thinking about consumer outcomes and making sure people can afford to get the credit. And what's sad is, while I say we had 3 million applications, we've also never declined more people than we ever have in the month of March too, because it's much harder to get credit.
And Chanuka, what's your view around, I suppose, risk appetite? I mean, have you got a similar kind of approach, or?
Absolutely. So we're also seeing that most consumers' discretionary income is really getting squeezed right now. And it shouldn't be surprising that any responsible lender is taking this time to step back and reevaluate their policies.
Yeah, and I suppose part of it sounds like, you've obviously got the new in. I suppose you've got the new adjudication, but then you've also got, it sounds like a lot of the issues probably coming from people who was affordable before, 6 months ago, and then there's almost like that account management, life management kind of aspect to it, and that's what's probably causing the delinquencies. Is that, or that's where the stress is, rather than the new people coming in? Have you got strategies around that in terms of like how you're thinking about sort of in-life management to try and control that? I mean, is that something we've really got to think about, particularly because things have changed very quickly? I mean, it feels like in the last 6 months things have really changed.
Massively. I mean, we think at Creditspring that it's actually the lender's responsibility not just to lend and make money, but to help build up a borrower's profile. So our mission is to actually improve financial stability. It's not to grow the loan book. So the way we sort of attack this problem is with personalized financial education, personalized scores, try to improve sort of monthly, weekly check-ins for people to get the information they need, for people to understand where they are, because we know it's actually going to get really hard out there. We actually launched what we call our Stability Hub during COVID as a response to, we don't know who to lend to, but we know people need help. So helping people know where they can get their benefits, for example, helping people know who they go to when they get in trouble with that. It's part of the whole robust process of having a partnership with the customer, because without a doubt, our existing customers are our best customers, but everyone's feeling the pinch from this. So how can we help support them, but still in a responsible manner?
Yeah. And I want to come back a little bit back to, I suppose, interest rates. I was just looking this morning. I think the interest rate now in the UK is 4.5%. So I mean, you think about where it was, a year ago, I mean, it's like dramatically increased. I mean, that surely must be taking, I mean, certainly from a mortgage point of view, that must be sort of like cooling the market somewhat. I mean, what impact do you think that's going to be? And the fact that it's changed so much, does it make it harder to look forward in terms of affordability, in terms of mortgages, Paul? Looking at you, I mean, what impact do you think that's going to have on the lending market? Is that part of the reason for some of the cooling?
Yeah, 100%, Chris. I think really, certainly, in any market, you need a very strong first-time buyer market within the mortgage industry. and if there's a big hesitancy on the first time buyers coming in, that then affects the second and third time onward buyers. So without those first time buyers who are, like everybody else, are struggling, or from what would have been maybe 8-9 months ago a payment of £1,000, that payment now could be £1,500, for example.
And what about the flow through to like people remortgaging when they come off their deals into remortgaging when the rates have increased? I mean, are you seeing problems around that? Because that obviously then people have got the assets sitting there as well in the background.
Yeah, it's very, very, very true. There's some quite tricky conversations to be had at the moment, because again, people were coming off, say, a 3 or 5 year fixed rate, even 2 years ago. It might have started with a 1, or even if they were lucky enough and done it at the right time, under 1%. Now we're talking about rates typically, even with a 40% equity within the property, very high threes. It's a big step change, and as I say, you have to have some open and honest conversations with people about potentially, when you've got their budget planner in front of you, what you feel is the right way to do. If people come back and tell me they can't afford it, you have to be quite blunt with people and say, well, you have this on finance or a car, you've got 2 cars, maybe it's time to reconsider what potentially losing one of the cars if possible.
Yeah. I mean, we talk a lot about cost of living, but I mean, and top of mind always seems to be around, how much I'm spending down the shops, or when I go to the supermarket. And definitely, I mean, inflation's running at over 10%. So I think it was a 41-year high, I think it was. But I mean, that interest rate element is part of it. So if you've got a loan, if you've got a mortgage now, and it starts to go up, I mean, that's also like compounding to the cost of living as well. I mean, Chanuka, I mean, do you see that as sort of increasing? Is that sort of making it further worse? I mean, and how do you sort of handle the instability in interest rates? Because we don't quite know. I mean, they keep talking about it sort of peaking, but whether that's going to go up further or not, or I mean, it depends on who you listen to, really. I mean, how do we sort of think about that in terms of like forward affordability?
Yeah, so I mean, we're coming off like some of the lowest interest rates and then going up to some of the highest interest rates that we've seen in a long time. We've seen the base rate increase 11 times over the last 2 years. So it's definitely something that we're keeping an eye on. And then the cost of borrowing really affects the profit margins that we're seeing in all lending companies within the industry. And I think what we're going to see is the more robust companies are going to come out on top. And the ones that have been relying on these low interest rates are going to start struggling or see their business model be challenged over time, especially over the next few months.
Yeah, well, I was going to come on and ask a little bit about, I suppose, interest rates and the impact on profitability, really, because I mean, definitely it's going to squeeze both ends if you can't do it. So, do you think there's going to be a shakeout as a result? I mean, is there a threshold of when you think the interest rate's going to become too painful if you can't sort of raise some of the top line rates?
I don't know if I have a number off the top of my mind, but there's definitely going to be a point where we're going to start seeing things start to stress out a bit more. Definitely.
Yeah. And what do you think the impact will be on that? Would it be consolidation in the industry, or do you think it will be just lenders are going to sort of struggle, I suppose, from a profitability point of view? But would it wash out in terms of consolidation?
I'm not sure if there'll be consolidation, but there will definitely be a shakeup within the industry, and it's hard to say exactly what's going to happen, but we're definitely going to see some changes if this continues to stay up this way.
Yeah, I mean, I suppose, and Louise, just going back to sorry to jump around, but just going back to the interest rate piece in terms of cost of living. I mean, how much of a factor do you think that is on consumer affordability in terms of like loans? I mean, are we taking enough of that into account in terms of if that starts to increase? In terms of people being able to afford loans from a consumer point of view, getting further stress from a cost of living point of view?
Yeah, I think what we're seeing from that increase in interest is a difficulty for customers to predict their financial surety, to know what they're going to be able to afford, as I said before. And I think that makes it very, very difficult to make the right financial commitments. Obviously, it also affects affordability, and it can be really hard for customers to navigate what they should pay, when they should pay it, how they should distribute the money that they do have. So I think it creates a lot of confusion. It creates that rise in things like illegal money lending, which we talked about. But what I would say is, whilst we don't know what the future looks like and we can't predict what's going to happen to the interest rate with accuracy, I think what we do know is it's going to continue to be quite unpredictable for some time. And I think that probably needs to be baked into lending and credit risk models, because if we know one thing for sure, it's that things are going to continue to be rocky for some time. And we need to be proactive on that. We need to be able to factor that in now to the support we're offering customers and to the conversations we're having as well.
Yeah, I mean, one of the questions we had before this was around whether you see any sort of green shoots of recovery. I mean, that sort of gets talked about. We haven't been very optimistic so far. I mean, do you think there's any sort of like light in terms of like looking around, sort of maybe like stabilization or things maybe looking like they might sort of recover a little bit? Or are we still in the middle of the storm, if you see what I mean, or maybe not even in the start of the storm? What's the kind of view? I mean, Neil, let's see what do you think?
Well, the green
Optimistic or
shoots,
not?
I'd say I'm not super optimistic at the moment, but I probably wouldn't be as pessimistic as everyone. And like the fact of the matter, there's a lot of things going on, but we really saw the cost of living crisis start to kick in around February, March last year. We noticed it with huge increase in application, self-reported expenses, utilities, transportation, and all that. And we saw a big spike in forbearance. We're not seeing that continue to grow, but it's both. All of it is still at elevated levels. So what we sort of think is we're not out of the woods yet, but it stopped increasing in a scary way. Speaking specifically for my membership base, they've been living in a cost of living crisis for longer than it's been a trendy word. And the near prime borrowers have always been trying to get through month to month. So interest rate rises for them is and this is maybe contrarian, but it's actually a good thing. These guys aren't borrowing; they're not about to go on a higher mortgage payment, etc. And actually, their problem is inflation and the cost of goods growing much faster than wages. So rate increases should help that, and we think it will help that. So helps our members sort of stabilize, but without a doubt, we're not out of the woods yet. I just say we're not panicking right now, but we're not out of the woods.
Yeah, I mean, and Paul, what's your kind of view from a mortgage from a mortgage and a real estate point of view in terms of the market? Do you think it's sort of going to stabilize, or are you sort of like looking maybe with concern in terms of the future?
Yeah, again, as it's been touched on, we don't really know where interest rates are going to go. However, if you sort of read the sort of financial expert sort of view, they're predicting or analysing that we could be there or thereabouts on where interest rates are now. So there was even a rumour that we weren't going to get an interest rate rise, obviously last week, but then the cost of inflation shot up and unexpectedly, and I think that really twisted the Bank of England's arm to move it. So I'd like to be on the optimistic side to say we're there or thereabouts on the interest rate rises, which should hopefully then start giving people a little bit more reassurance that this is where we are, this is how much it's going to be in and around the area, and hopefully that will then bring people out to start saying, right, especially the first time buyer market, because they know no different. This is going to be my cost. If I'm paying X amount in rent and my mortgage amount is going to be similar or lower, then hopefully that gives them the confidence to come out.
How much of it is a question around just, I suppose, stability as much as what the actual interest rate is? So, I mean, do we need to have having a stable system where it becomes predictable? Is that more important than, I suppose, what the actual rate is? Because it feels like, because this keeps on increasing, which makes it very hard for consumers as well to predict what their future outcomes are going to be, and so it's sort of it's concerning, which then might actually restrict people around whether they do borrow unless they need to. I suppose is kind of what we're hearing.
Yeah, I think stability. Yeah, you're right, Chris. Is going to be a major factor, and as I say, if you follow the experts or financial analysts, they're saying now that we may not see any more base rate rises for a while. And I think that will then give the confidence to people to bring in the stability that they need to say, okay, this is where we are. Hopefully this is where it's going to be. And that gives them the confidence of hopefully coming back into the market and knowing their full costs, involved with purchasing.
Yeah, I mean, I suppose, and if we get to a stable kind of point, and Chanuka, coming to you, just I suppose, how do we start thinking about it? So if the interest rate is going to be this much higher now, I mean, strictly from a funding point of view, how do we start thinking about how we manage in a higher risk interest rate kind of environment? I mean, what does that do to I suppose, to risk appetite, some of the scoring models, how we think about lending, but then also the account management and life management as well? I mean, how are we going to need to adapt from what we've been doing historically when we've had very, very, very favourable rates, I suppose?
So it's definitely something that we need to we always need to keep an eye on, especially balancing what lenders are charging to customers, as well as balancing back off with borrowing costs. I think what's going to be happening a lot more is that firms are going to have to start reevaluating exactly what their positioning and what their offerings are to the industry. And I think we're going to see more momentum in these kind of companies reevaluating what products they offer, and then what does that mean to their borrowers.
I mean, what do you think? What do you think the themes will be in terms of like different types of products? I mean, is there still, there must be still profit to be made within certain segments of it in terms of like how you then further segment it. I mean, and Neil, you talked a bit about sort of declining more people than you've ever done before. I mean, is that how you look at maintaining profitability in terms of like the segmentation? I mean, do we have the information we need to be able to do that? And how does that then link to I suppose the decisioning piece? I mean, what do you think the future holds for us?
Well, I mean, I think we just have to adapt. So, again, if you just want to be a pure lender, then, higher rates, all things equal, means your profit margin goes down unless you raise prices, right? But I think it's the role of lenders to step up, and it's actually an opportunity to say, this is extremely important to society, whether people like it or not. Lending's been around for 5,000 years and be around for more than that anyways. And how do we take advantage of this crisis to make it more wholesome, make it more robust? And like I said, we're trying to say, what else can we do to support you? We understand the lending is the key piece, but if you can, getting that certainty and stability on your monthly payments, knowing exactly how much you're going to have to pay, using technology to give people alerts to know when they need to pay, making it easier for people to come back, to know when they're late. All those sort of things add 1% improvements all over the place, and it makes it an easier proposition for someone to borrow. And if a lender plays it right, they can find a lot of other ways to offer value, and then they can charge for that value. It's not just about passing on the price rise. So there's other ways to say, look, now people are going to be struggling with, having less money in the bank. So for example, just launched this benefits finder tool, nothing to do with lending, but it helps our borrowers. It's going to help us get paid, help people pay us back. So it's good for us, but it's a simple new product for them, and then it's what can people really care about their credit score? Can we give them more visibility around that? And there's millions of things people can do. Every lender could take a different approach, but it's about finding value for the members, and for the consumers, they have more problems to solve now. So if you solve the problem in the right way, there's a way to make it profitable as well.
I mean, Chanuka, I'm going to come back to you. Just you must have a view on that as well in terms of like how you think, particularly as the unsecured consumer credit market, how we can help borrowers when they're going through this stress. I either maybe split that just in terms of existing borrowers, but then also new borrowers who are looking for credit as well.
Yeah, so there's a few things that we need to continue to look at. One is that one thing that we were trying to prevent, particularly at Zilch, is loan stacking. So that is preventing consumers from paying off credit with other credit. So that's, we don't want to keep consumers perpetually in a credit cycle, essentially. So that's one thing. And the other one is making sure that we integrate with debt charities as well. So at Zilch, we have a partnership with Step Change, and we've found that consumers have been getting more support and to get a better understanding of their financial position, and they act very well within a timely and responsible manner as well.
Yeah, and how does this relate, I suppose, from an unsecured point of view into the secured market? I mean, Paul, you heard a bit about sort of like how the unsecured market, I suppose, can try and help consumers and sort of be in a position to try and help them. Does that have any kind of relevance to, I suppose, much which were like asset-based lending, and it's much more sort of like longer like lifespan, 20, 30 years kind of. Are some of the themes kind of relevant that you can then push through, and is that a theme that you're seeing within the secured market? at all, or is it more stable? I mean, it feels like you've got quite a different experience than what we're seeing elsewhere.
Yeah, obviously, it's you're quite right, Chris. It's probably the flip of the coin, really, for our side, with obviously Neil and Chanuka being sort of very busy, as they say. So, from our point of view, of course, credit is bad for us as a mortgage broker, because the more credit you have, the worse it is for the client, because unfortunately, whether this is right or wrong, the way lenders perceive credit card risk is the highest form of lending. So their affordability calculators are stricter for someone that will be carrying over a credit card balance, for example. So so from our point of view, when, as we touched on, when clients do have quite a lot of credit, it's unfortunately it's detrimental to them to try and obtain the highest amount of mortgage that they can get, and potentially not get the property that they're after, or the remortgage that they're looking for.
Yeah, it's quite interesting how we have almost like two sides of the coin. It's a bit like interest. It's a bit like interest rates and cost of living, like and inflation. It's like the more you put interest rates up, the more it controls inflation. But then that also increases the cost of living for people as well. I mean, and funding costs as well. So it's sort of like we're in this sort of like trying to find the Goldilocks zone, aren't we? Of just trying to get it just right. And Louise, I was going to come to you just, I suppose, to comment really around what do you think, sort of as a almost like as an outside party, what can creditors do to sort of, I suppose, really help borrowers in some of the stress situations that we've kind of hear. I mean, you heard a bit from Chanuka and Neil around some of the things that they're doing in terms of like how do they add extra value. I mean, what's your kind of view in terms of like themes that you're seeing, or themes that you think people need to think about?
Yeah, so we do see some really positive things that are happening. Firms being cognizant of the challenges that customers are facing, as simple as it sounds, is incredibly effective. Baking that into their lending models, their collection models, ensuring that staff are trained on things like the cost of living crisis, that they understand the impact it's having on customers. Firms looking at the data that they have, making sure it's being utilised to the best possible advantage, making sure it's being utilised to understand the customer's past, present and future position, looking at things like the forbearance options that are available, which is something we saw in the pandemic, firms really adapting the sort of solutions they had available to support customers when they hit financial difficulty. And also in the decline space, it's important that firms lend responsibly, right? And there are going to be times when applications just have to be declined. But that doesn't mean that support can't still be given at that part of the journey. So we see good outcomes where firms are declining applications, but explaining the reason why, explaining the core factors that led to the decline, and signposting them to free debt advice or to the credit reference agencies so they can try and take control of that credit that they're seeking.
Yeah, and I suppose some of this is going to get amplified, I imagine, with Consumer Duty that's coming on later in the year. I mean, I know a lot of people are sort of making a lot of progress towards that already. I mean, do you think is that coming at the right time, or do you think it's a little bit late? Louise?
Difficult one, really, because obviously it sits with the FCA. But what I would say is we would always welcome anything that drives up customer outcomes, and obviously the Consumer Duty speaks a lot about helping ensure that you get the right outcome for customers, that you're testing that when you're building products and services. So I do think it will drive up those standards and help guide firms in that space.
Yeah, it does feel like it's sort of like coinciding with what is, after COVID. It feels like it's coinciding with what is, cost of living crisis, and if people are working on it now, I mean, we're seeing it now. We've been seeing it over the last year, but it feels like it's sort of quite timely. Just like how it's kind of like flowing through. And in terms of like trying to get information to help people, I mean, are there different sort of like sources of information that we need to look at? I mean, Chanuka or Neil, I don't know if you have new innovative sources of information to help make those risk decisions. And so I suppose and try and work out, because you're trying to find out what might happen before it actually happens to the largest extent. I mean, are there new sources of information we can actually look at that maybe we're not utilizing, or are utilizing now that we didn't? It used to be was based on credit bureaus. I mean, Chanuka, have you got? I mean, you might have quite a rich source of information coming through.
Yeah, absolutely. So on our side at Zilch, we've been looking at open banking as this form of like alternative data. So by using open banking, we're trying to see exactly what position the customer's in at that point in time, rather than getting a standardized view that's on a monthly cadence from credit reference agencies, for example. So by trying to acquire new forms of alternate data, we're trying to get the most up-to-date form of position of the customer. Therefore, we have a better understanding of our customer and offer them a more unique product to their.
What comes next? What comes next after open banking? We talk quite a bit about open banking, and because it helps sort of fill in the gaps, doesn't it, in terms of like recency of data? Do you think there are other sources out there that we should be looking at, or do you think it's just a case of open banking? We haven't leveraged it enough yet.
So there's other forms of information that we can definitely use. So understanding that the consumer is paying things like rent on a consistent level shows that they have a good financial position, they have a good understanding of their own financial position, and that they know how to prioritize their spending. So looking at other forms of information such as that could be an alternative that we could be looking at.
Yeah, Neil, what's your view, I suppose, in terms of like, I mean, is it a question we're not making enough of the data we've got already, include open banking within that? Although I know not everyone has it yet, or is there an extra world of data we should be looking for new sources to, I suppose, to find the value or to find where the issues are, we can add the extra value.
Yeah, well, it's all about data. Like we have computers now that can process basically infinite amount of data to make better decisions, right? So that's the first step. So it's how much data can you feed that, and also the speed of it, the quality of the data, et cetera. So open banking is what we all talk about all the time. It's super important. We use open banking. The value there is that it's pretty much real-time data, but not to pour cold water on it. It's not the be all and end all. And we make scorecards using traditional bureau data that are just as predictive as open banking. And then when we overlay the two, we get a better decision. And then we'll also use, we call it metadata, but we'll look at stuff on how people might complete an application or what their behavior might be just within Creditspring, because every data point can be very valuable or not. What I would say is, just simply the big value of open banking, in my opinion, is that it's real time, right? And one of the biggest constraints with traditional CRA data, Chanuka already pointed out, is it's delayed. It's, the data could be stale. Some guy could look great on credit record, but it turns out he took out a bunch of high cost short-term loans in the last week and no one would know. To me, that seems like a solvable problem. If we can get the bureau data much faster and fresher, the lenders are all in the ability to give that data almost in real time. The bureaus should be able to give that as well. That would be a massive impact. I mean, credit worthiness matters a lot, and you get a better predictor of credit worthiness with credit data. That's just a fact. Open banking data is really good, and it has and the key thing is they're different sources of data. But I think those two by themselves, make them as fresh and as fast as possible, would help lenders make much better decisions. Yeah. But we should all be cognizant that we are in the risk business and we're trying to predict the future. So, we can make a great decision today and then the world can change tomorrow and it messes everything up. So again, that piece there is about recalibrating your models and machine learning and all that stuff. And more people are starting to look at that as well.
So you talk about, I suppose, recency and updating the data, which seems very relevant we've got such a changing environment. I mean, we still, a lot of people still get paid monthly, or they'll get paid, maybe even weekly, although increasingly less so. I mean, we still actually worked quite a monthly cycle. I mean, do you think the recency thing is important because of the change that's happened and the fact that change is happening so fast? And if that goes away, then maybe it's going to become a little bit less important, because you want to know, well, has someone borrowed a lot in the last 30 days, which will really help you, rather than what their long-term repayment ability is. I mean, do you think we're going to move out of this sort of like fast-changing world where recency is important to maybe back to more of a stable kind of monthly type basis, or do you think it's here to stay?
I mean, I think people are extremely complex and volatile, that on the whole, you could probably re-underwrite one person on a monthly basis, maybe even a quarterly basis. But like I said, when you're processing like millions of applications a month, like you need that data to be as fresh as possible, and we have plenty of stories where guy looked perfect, credit score was great, was a no-brainer to give them a loan, and then it turns out that in between the period when our data was sent to us, well, the data we were using, and when we accepted them, they had done a whole bunch of, they had gotten themselves into trouble, down debt, and you can't blame them. There's always this sort of cascading thing. And if you don't have a recent data set, you're never going to see that. And that's where there's also the negative selection. That type of person is going to be applying more often than not. And the lenders just don't see that.
Yeah, I mean, because it's interesting whether the recency of data kind of changes by industry. So, you know, where the space that you're in, I mean, you need to maybe you need to have much more sort of like recent information. I mean, the mortgage market. I mean, do you think you ever gonna is that going to be valuable? I suppose, you know, almost like the last 30 days, if someone's significantly changed. I mean, is that something that's been looked at in the mortgage market, Paul? Or do you think that the monthly kind of credit bureau information is still where most people are at? It's a much more stable, feels a much more sort of stable because you're lending for a much longer time period.
Yes, yeah, I agree, Chris. I think sometimes though, from the frustrations we can have sometimes as a broker when we speak to lenders, is that a bit like what Neil was saying, that it could be quite handy sometimes to have the up-to-date information, because if someone has cleared a credit card, for example, that can stay on someone's credit profile bureau data for about up to 7 weeks, depending on when the sort of refresh is done. So sometimes from that thing, the lender will automatically reduce the loan amount down for obvious reasons, because they're picking up that data. So I think there's a for and against that from the mortgage market. In that instance, certainly that would help. But you're quite right in thinking a mortgage is obviously predominantly over, you know, many years. So a longer term view on that helps. But there are some instances where the short term can also help us, and you know, without then having to, you know, upload information to the lender with a bill or whatever to show that the client has paid that debt literally in the last few days.
Yeah, so I mean, so that's a recency, but it's also an evidencing piece as well, isn't it? So you can like evidencing, you know, salary and those those kind of things. What about new technologies? I mean, we're just talking a little bit about. I mean, ChatGPT's been in the been in the news quite a lot. I just recently this week I got access to Bard, so I was doing a comparison between the two. I mean, is this a fad that's coming through? I mean, what do you think around that in terms of lending decisions? And I know it's sort of like large language models, but you know, will any of that come through, do you think, in terms of some of the, I suppose, the credit risk and the underwriting process, particularly on things like, I suppose, explainability and those kind of things where you sort of like trying to understand it? I mean, have any of you sort of started to look at that, or started to think a bit about that? Sometimes these things I know can be a bit far away. Anyone got a view?
We've obviously looked at it, and you know, I would say extremely scared and frightened to have that go anywhere near our decisioning, because we have the responsibility to make correct lending decisions, and we're not going to say, oh, you know, the robot did that and that's all it was. So, you know, I would say that's far off in the horizon. I mean, all the statistical models, decision models that we're using are all sort of state of the art, you know, machine learning, AI and all that stuff, but we control it. So we can explain it. We know exactly what variables we want to use. We even will we actually will remove some variables that might be predictive because we don't think they fit with our business philosophy and stuff like that. So on the face of it, I can't see, but I would love to hear if anyone else thought of it. But from a whole business perspective, we're wondering, can this help our members more easily digest financial advice and news articles? Can it summarize it for people? Could we actually use it to help our members get support faster? But, you know, understanding the FAQs and all that sort of stuff. But with regards to the lending decisioning, I'd be pretty nervous about that.
Yeah, I have a similar opinion there. I think the AI space is definitely growing, but we're pretty cautious not to throw it into decision making right now. I think what it could be used right now for is augmenting like the data science world that we use to build models that we make our decisions on. But using AI specifically for making decisions is probably a bit further in the future for us right now.
I mean, the question being raised here, I suppose, a little bit around explainability, isn't it? I mean, so you don't want to have something going off where you can't explain it. There could be inherent bias within the models that you don't necessarily understand, and so you wouldn't want to anywhere sort of like near, I suppose, any kind of decisioning where you couldn't explain it. I mean, Louise, I was going to ask you just, I suppose, from a, you know, what do you think in terms of like that whole piece around transparency around decision making? I mean, certainly in the US, they have to have, you have to be able to give the reasons for a decline. I mean, how much of that, we've talked about that already a little bit on this call, but how much do you think how important is that, and how much is that going to start to come through in terms of really explaining why people would decline, and the details around it, giving them extra information? I mean, is that a theme that we're going to see come through more strongly, particularly with the cost of living?
Yeah, absolutely. The need to be transparent with customers and help them be autonomous it's vital, and it's something we talk about in our standards and our business and personal standards. It's about putting the customer in a position where they can take forward their financial needs, right? And so if you are using that technology that's very data driven, help the customer understand what went into that decision making and how it's been evaluated, to put them in a position of empowerment. I think it's also really important when we're thinking about these kind of models that we're considering inclusivity. So are we sure that that model works for every customer? Are there any customers that are going to be left behind? And I say that, there's some really exciting technology at the moment. And of course, we would advocate anything that increases better customer outcomes. But I do think balancing inclusion is also a really important factor.
Yeah. I mean, and how far do you think we've come on that? And we've talked a lot bit about digital lending, and those kind of, you hear inclusion starting to come back into it. I mean, do you think we're moving forward in terms of that, particularly with, I suppose, all the discussion that's been around that, I suppose, purely digital kind of processes? Or is that there's still a gap for us?
Do you mean, is there a gap in terms of achieving inclusivity?
Yes.
I think there's always more we can do in that space, and we do hear and we do speak to different groups that tell us they still can't get the access that they need, or they can't access the services and products in the way that they've been designed. So I think there is more work that needs to be done in that space.
Yeah, it does feel like, so again, it comes back to that theme of change, doesn't it? Where you sort of like, you've got, and you almost like have two aspects of the same coin, which is driving digital can help drive efficiency, drive access to credit. You can take costs out. On the other hand, and then you want to have inclusivity as well. I mean, go ahead.
I was just going to say, just to sort of bring a bit of positivity to what I've just said. I think there is a way around that, right? It's developing any solution, whether it's a new credit risk model, a new lending model, or a new piece of AI, developing it with all of your customers in mind, knowing who your customers are, and then testing that before it goes live to make sure it actually will achieve the right outcome and the right holistic view for every customer on the book. So it's not to say that those things shouldn't happen. There is a way to achieve inclusivity, but I think it starts at that design stage.
Yeah, and if you go back to things like large language models, it's a good way of sort of like distilling lots of customer feedback down to summarizing that, so you can then use it. I mean, so it sort of takes. I understand that there can be bias reasons in decisioning, which you've got to be very careful of, but you can go back to the core data in terms of like summarizing information. I think is quite interesting. And I suppose. Go ahead, Neil.
Oh, I was just going to say one thing there. I totally agree with Louise, and that's why, like, the danger of these super predictive models is, like you said, the unexplainability. So, like, we think it's important to have, find the best models, but then take a step back and say, can I actually explain this? Does it make common sense? And, like, for example, quite a big bugbear of ours internally is that, many lenders in the UK will still make lending decisions using postcode data. We think that's pretty wrong. We've run the numbers, and postcode data is quite predictive on a wide sample, but we don't think it's fair that someone should get penalized for living in a specific postcode. And that could lead, that's not very inclusive at all. But like, so we've made that decision at the cost, as you say, Chris, of maybe a better decisioning model. But it's sort of, the benefit is as a more inclusive type lending decision. But I think you need that, AI plus, or whatever you want to call it, automated decision plus human common sense, and that combination should hopefully get you a little bit further to where you want to be. But
it's almost like how are we going back to almost like old school, which is how do you use the technology to almost get down to individual decisions rather than group-based decisions. So a couple of questions have just come through. Kind of just posted there. So just on open banking, how are you finding, I suppose, categorization of open banking and the quality of that? Is that, I know that's been an issue sort of historically. Is that still, you're still seeing that as an issue or a challenge that you're coming through? Any kind of views on that? Chanuka, you were quite quite keen on the open banking piece. Are you still, or is categorization still an issue, or has it become less of an issue now, just the way you sort of use the data?
So I think there's like globally, there's more, hundreds of thousands of merchants. It's a very difficult problem that we're trying to solve everywhere. We work with Diapoli as our partner in open banking. And I think they've actually provided a very sustainable way of using categorization, where we're finding their tools actually very good, and it's giving us very accurate results as well. So honestly, I think it's a problem that's starting to be solved now, and we're seeing good results in that area.
Yeah. Okay, that's good. And there's a question. Just another question that's came through just around, I suppose, consumer duty and operational processes and how you sort of like embedding that in. I know we're going to talk a little bit about regulation later on in the sessions, but any kind of views around sort of like how you're sort of treating that or how you're thinking about that? Maybe just ask Chanuka, Neil, and Paul before we kind of finish.
I mean, consumer duty, again, like we think it's super important. And if you get it right, it's better for all parties because we're taking a long-term view here. The timing couldn't be better, as you said earlier. And if you look at the explosion of payday loans from 2009 to 2010, it was right after another sort of crisis. So having this consumer duty right here grounding everyone, I think is extremely important, because lenders can make a lot of money if they disregard consumer duty. And the FCA is saying that's not okay. And we're quite happy to see that. We're just looking at the whole business. We like to think that we have nothing to worry about because we've always put the customer first, and we've always made sure that they can afford it, they don't get in trouble, etc. But this is a great opportunity for us to kick the tires on every part of the business and make sure that we're, well above what the line is on consumer duty.
Do you think there's operational changes that are kind of needed, or do you think that's? I mean, you're saying it's pretty much embedded with what you do already, I suppose, at the moment, and it's the evidencing piece that's causing the headache.
For us, it's not as bad just because we're a new business. So we launched in 2018, so we have pretty high data capabilities. Everything is sort of in the cloud, all this stuff. So it's been sort of the foundation is set up that it's sort of just maybe polishing a few things off here and there. It's not a total, but if you were a more established lender, say lending for the past 100 years, you've got infrastructure, legacy systems, like that's going to be a big problem. Or maybe not problems, not the right word. That's going to take a lot of time and be a big challenge to get in shape.
I mean, Paul, talking about, there's been legacy lending. I mean, the mortgage market's been around for a long time. I mean, are you hearing noises around that being more complicated for that kind of sector than the sort of like the newer sectors that Chanuka and Neil are in?
I wouldn't say so. I mean, I think it's fair to say, a bit like what Neil was saying, that hopefully we're doing the right things anyway when it comes to like the consumer duty piece. It looks like we're going to be dictated to a little bit by the lenders because there might be some additional documentation we need to be completing. And I think that's probably a little bit more of a follow-up for the client to make sure that there's actually something that's going to come from the lender to ask them that they actually understand, and whether that's from my point of view, as in I've explained it correctly or they've read everything correctly. That seems to be the piece that's going to come from the lenders. It's still, we've seen a couple of little drafts and we've been asked to comment on a couple of little things. But it does seem to be, from our point of view, that consumer duty will be probably led quite heavily by the lenders and asking for additional bits of information, maybe to be read, signed, and but then returned back to them.
Yeah, it does feel like there's going to be quite a lot of change that could come through in the next sort of like 3 or 4 months, because it's not long to go now. I know. So, I mean, just to close off, I suppose I just kind of ask each of you, I suppose, in terms of like, where do you sort of like see, I suppose, credit risk adjudication in the market, sort of, and cost of living sort of going over the next sort of like year, 18 months? I mean, we talked about whether we've reached a peak or not, or I mean, what's the I mean, we've been very sort of, I feel like we've been a little bit pessimistic in this hour. We should be trying to be a little bit more upbeat. I mean, where do you kind of, what's the exciting piece? Where do we go from here? Louise, maybe do you want to start?
Sure. I know it's slightly different, but I always keep thinking about the pandemic recently, because I think for me that's an example of where, as an industry, we all clubbed together hugely to adapt to this unprecedented crisis, to the payment holiday guidance which came into place, and the need for like really rapid change to deliver fair outcomes. And we rose to that challenge and we delivered some really, really great solutions. So for me, I think there's going to be more adaptability. I think there's going to be more need to think about alternative ways of underwriting, of supporting customers. But I do feel optimistic from the pandemic, oddly, that we can actually do that because we've done it before.
Paul, what's your kind of view? I mean, so this flexibility, do you think we develop more flexibility as a result of the pandemic, so that's sort of putting us in good stead, or how do you see the next sort of 18 months?
Yeah, I think lenders are a lot more open to people that are, I always say to clients, if you're in trouble, speak to your lender, and it's the number one thing. And unfortunately, so many people will bury their heads and into the sand and try and forget about it. But we are finding lenders are a lot more open to helping people, as they should do, especially as we've talked about, mortgage lending just overall is the lowest it's been for 7 years, excluding the pandemic months, when, pretty much the whole country was locked down for, 4 or 5 months and there was a closure in the sector. But, to be a bit more optimistic, like I said earlier, we are seeing some green shoots. We are starting to get those first-time buyers starting to look and starting to buy. And that then moves the industry forward to the second and third-time buyers, who can then look to move. Because if they've sold their property, then they can then look to move on. And I think it's just getting the client, my client base, to understand that hopefully if base rate is going to stay where it is, fingers crossed, we're going to get into a period of stability, which will then hopefully settle the markets down, to then be able to bring the confidence back in. And as I say, we are seeing a few green shoots, and let's hope that continues.
Yeah. And Neil and Chanuka, Neil, what's your outlook?
Well, like I said, I think we're in the next 12 months where it's a little bit tricky, but the optimistic outlook would be if you can combine this focus on consumer duty with the fact that there is still a lot of demand for credit, and that all these lenders have all these new tools and technology available to them, people will come up with solutions that work in this environment. And if we assume that we're not out of the woods, but the rate of growth in the cost of living has sort of subsided and we're sort of at the high end, all this stuff combining together will mean when stuff starts coming back down and when the economy starts recovering again, we'll all be with a much better setup, which works for lenders and customers.
Yeah, I mean, Chanuka, your final word, I suppose. It just feel like this. We've got more flexibility than we've ever had. So that sounds like that's a good thing, just as Neil was explaining.
Yeah, honestly, I mean, it might be an uncertain or a turbulent time right now, but what that means is it's probably the best time for innovation to come out. It's where people are going to be the most creative. So while there might be a bit of uncertainty in the market, I think we're just going to see some very interesting things coming out of the industry in the near future as well.
Yeah. Yeah, often, times of crisis is when we have a lot of innovation, isn't it? Which,
Absolutely.
We definitely saw that through COVID. So, well, thank you to everyone on the panel. Chanuka, Neil, Paul, and Louise, thank you very much. Really appreciate it. It was a great conversation. And Colin, I'll hand back to you.
Yeah, thanks, Chris. Yeah, thank you to all our panel as well. Really good, really interesting direction, and lots of different views from different parts of the sector. It's interesting to hear how different they are really at times. So thank you for that. Moving forward, so we're going to have our next session coming up at 10:45 for those who want to join that. That's going to be discussing measuring affordability. So we're going to have a break for 15 minutes or so. For those of you who want to join us, that'd be great. But we're going to round up now and say a massive thank you to Chanuka, Louise, Neil and Paul for their insight, and of course Chris for chairing the session. Hopefully we'll see everybody again soon, but thank you to everybody for now, and we'll see you all soon. Thank you. Bye-bye.
Thank you.
Thanks.